Well, guys, I got a good question today. Veronica, thanks for this question. It was in terms of, this past performance thing. We always talk about don't look at past performance when you're investing, and we don't want to look at that. Doesn't make any sense to look at that. And people often ask me, well, what do you look at? I mean, why don't you look at past performance? A lot of times you guys talk about market returns in the past. Aren't you looking at past performance? Well, there are two types of past performance that I want to explain to you. Number one is the past performance of a fund manager, let's say a manager that invests in small company growth stocks. Well, how did that fund manager do versus small company growth stocks, the just natural growth of that area of the market? That's what we're talking about, fund manager. We're talking about in terms of past performance. Don't look at the past performance of the fund manager and their ability to have outperformed that area of the market in the past, because that's not necessarily repeatable. As a matter of fact, studies show that it's not repeatable at all. So that's what I'm talking about. Now, what am I talking about when I talk about past performance? What past performance do you look at? Well, when I'm talking about past performance of markets, I'm looking at something that has a better shot of being repeatable. And in other words, if I go down to my local bank, let's say, and the local bank says, we're going to borrow your money, and we want to borrow your money. We want you to buy a CD from us, and we'll pay you 2% for your money, or something like that. Well, what's being repeated here is that the bank typically pays a rate of return that is slightly above inflation. In fact, if we look at Treasury Bills from 1926 until today, the average return above inflation has been 0.7% per year above inflation. That's something that's repeatable. It's a pattern that we see because literally the bank is going to have to pay you to use your money. We know that probably it's going to be repeatable. They've had to pay you in the past to use your money, a rate that's a little bit above inflation. They'll probably have to pay you that rate of return in the future, which is a little bit above inflation. It's very, very consistent. Same thing with stocks. If I'm dealing with the stock market and I'm looking at large U.S. stocks, we know historically the average rate of return historically has been about 7% above inflation for large companies and about 9% above inflation for small companies. And what's likely to happen in the future is that that return will continue on. Now remember, the return in stocks come from the fact that instead of getting interest payments from the companies, the stocks that we own, we get the profits of those companies. Is it repeatable, for instance, that we are likely to continue to get the profits of companies when we buy their stock? Well, of course, we wouldn't buy their stock if that were not the case. So that's a repeatable type of past performance. And good question, Veronica. Appreciate it. And if you guys have questions, you want to run something, maybe this isn't totally clear to you, make sure you email me, paul@paulwinkler.net, or leave a comment below this video, and I'll get to your question on the next video. Thanks.